Understanding loan repayment, a comprehensive guide. Repayment is an essential concept in personal finance, encompassing the act of returning borrowed funds to a lender. Understanding the intricacies of loan repayment can help borrowers manage their debts more effectively and avoid potential pitfalls. This guide will delve into the details of loan repayment, types of repayment plans, consequences of non-repayment, and strategies for managing repayment challenges. What is loan repayment? Loan repayment refers to the process of paying back the amount of money borrowed, known as the principal, plus any interest charged by the lender for lending that money. Typically, repayments occur via periodic payments made at regular intervals, which could be monthly, quarterly, or annually. Key components of loan repayment. 1. Principal, the original amount borrowed, which the borrower is obligated to repay. 2. Interest, the fee charged by the lender for the privilege of borrowing funds, usually expressed as an annual percentage rate, APR. 3. Repayment terms, the specific conditions under which a borrower must repay the loan, often detailed in the loan agreement. Borrowers often have the option to repay loans fully at any time, however, they should be aware of potential early repayment penalties outlined in the loan agreement. Types of loans and their repayment plans. Loan repayment structures can vary significantly based on the type of loan. Common forms of debt include auto loans, typically have fixed interest rates and are repaid over several years with monthly payments. Mortgages, long-term loans designed to finance real estate, often spanning 15 to 30 years and may have variable interest rates. Student loans, generally offer flexible repayment plans, including deferment options for borrowers pursuing further education. Credit cards, require minimum monthly payments, and high interest rates can lead to substantial debt if balances are not managed properly. Each loan type carries specific repayment conditions designed to meet the borrower's needs while maintaining the lender's risk management. Consequences of non-repayment. Failing to meet repayment obligations can have severe consequences, including late fees, additional charges incurred for missing payments. Credit score impact. Late or missed payments negatively affect your credit rating, making it difficult to secure future loans. Collections. Persistent non-payment can lead lenders to send the account to collections, initiating legal actions like wage garnishment or asset seizures. Bankruptcy. In extreme situations, inability to repay debt may lead to bankruptcy, which has far-reaching implications for future borrowing. Preventing loan default. To prevent default, borrowers facing difficulties in repayment should maintain open communication with their lenders. Many lenders offer alternatives such as restructuring loans, temporary forbearance, or deferment options for qualifying borrowers. Debt management strategies. For borrowers in temporary financial distress, various strategies can be adopted. 1. Forbearance and deferment. Forbearance and deferment allow borrowers to temporarily pause or reduce payments without incurring significant penalties. While interest may accrue during forbearance periods, these options can provide crucial breathing room during financial hardships. 2. Loan consolidation. Consolidating multiple debts into one loan simplifies payments, often resulting in lower monthly costs. However, it's important to be aware that while the monthly payment may decrease, the overall interest cost over time may increase. 3. Negotiating with creditors. Reaching out directly to lenders or creditors can sometimes yield beneficial arrangements, such as reduced rates or modified repayment terms. Many creditors are willing to work with borrowers who proactively address payment difficulties. 4. Credit counseling. Non-profit credit counseling agencies can help borrowers manage debt effectively. They can provide financial management advice and assist in negotiating lower interest rates or waiving fees with creditors. Understanding grace periods. A grace period is an interval after the due date during which a borrower can make a payment without incurring late fees. Not all loans offer grace periods, and interest may still accrue during this time. Understanding the specifics of grace periods can help borrowers better manage their cash flow around due dates. Alternatives to loan repayment. For those struggling to manage debt, bankruptcy is often seen as a last resort due to its long-term financial repercussions. Alternatives include negotiation, forbearance, seeking debt relief programs, and exploring debt consolidation options to lighten the burden of repayment. Conclusion. Loan repayment is a fundamental aspect of borrowing that involves returning borrowed amounts plus interest to lenders. It is crucial for borrowers to understand their loan terms, including repayment schedules and potential consequences for defaulting on payments. By exploring debt management strategies and maintaining communication with lenders, borrowers can navigate the challenges of loan repayment effectively. Whether it's seeking forbearance, consolidating debts, or engaging with credit counseling, there are options available to help you regain control over your financial obligations.